Imagine you wake up tomorrow and you are the owner of a real estate investment business. Buy a couple of multifamily apartment buildings, hire a full-time property manager, answer the emergency plumbing calls at 2 in the morning, and hand over the keys to excited new tenants moving into your dining room. But here's the strange part. Real estate ownership is universally considered the ultimate American dream, the premier asset class for building generational wealth, and the single most romanticized path to passive income on the planet. Over 90% of the world's millionaires were created through owning real property, and every self-proclaimed guru on the internet will tell you that real estate is a risk-free money printer fueled by leverage and tax loopholes. Yet despite operating in an industry where human beings literally cannot survive without your product, local independent real estate businesses are quietly collapsing at an alarming rate, bogged down by crushing interest rates, unexpected capital expenditure disasters, and squatter nightmares. Anyway, by the end of this video, you'll know exactly how that's possible, how real estate owners actually make money on the inside, why collecting thousands of dollars in rent every single month still isn't enough to keep your portfolio solvent, and why owning real estate isn't really a housing business at all. It's a high-stakes capital allocation, debt management, and tax arbitrage game disguised as shelter. Residential real estate investments generally fall into three primary tiers, and financially speaking, they are three completely different animals. On the lower end, you have single-family rentals, or SFRs. These are your standard suburban three-bedroom houses costing anywhere from $200,000 to $400,000 to purchase, offering lower barrier to entry but extremely high vacancy volatility. In the middle, you have small multifamily properties, duplexes, triplexes, and fourplexes, costing between $500,000 and $1.2 million, which give you multiple income streams under a single roof. But at the top end of the residential food chain, and the scale that serious wealth creators target, is commercial multifamily real estate. Think 40 to 100 unit garden-style apartment complexes costing anywhere from $5 million to $15 million to acquire. To purchase a standard 40-unit apartment complex in a growing suburban market, your initial capital outlay is massive. Even though real estate allows you to use bank leverage, you are looking at needing around 25 to 30% down in equity. On a $6 million purchase price, that means dropping $1.5 million in hard cash just for the down payment. Add another $150,000 in commercial loan origination fees, $50,000 for environmental inspections and structural engineering reports, $30,000 for title insurance and legal fees, and another $100,000 in immediate capital reserves required by the lender, and you are burning through nearly $1.8 million before a single tenant pays you a nickel in rent. Most independent operators pull this off by syndicating the deal, putting down 10% of their own money and raising the rest from passive limited partner investors who expect an 8 to 10% preferred return. That means before your leasing agent tours a single prospect, your business is carrying a $28,000 monthly mortgage payment hanging directly over its head. So how does the money actually flow in, and where does it all go? Let us break down a 40-unit residential apartment complex, pulling in roughly $720,000 a year in gross potential rent, which works out to an average rent of $1,500 per unit every month. On paper, $60,000 a month in gross revenue sounds like an absolute cash machine. But running a real estate business is like trying to hold water in a bucket made of mesh. Everything in this world is governed by a critical metric known as the operating expense ratio, or OER. In a healthy multifamily asset, operating expenses typically devour 45 to 55% of every single dollar collected, long before you pay a penny on your mortgage. Let us look at the first massive slice of that rental income: property taxes and insurance. Real estate is unique because municipal governments essentially act as equity partners who take zero risk but demand a massive cut of your gross revenue every year. Property taxes alone can easily swallow 10 to 15% of your gross income, running roughly $75,000 annually on a $6 million asset. Then comes the silent killer destroying landlords across the country right now: commercial property insurance. Due to surging natural disaster claims and inflation in construction materials, insurance premiums have skyrocketed by 40 to 70% in recent years. Insuring a 40-unit complex against fire, wind, and liability can easily cost $35,000 a year. Out of your $60,000 in monthly gross rent, over $9,000 instantly vanishes into property taxes and insurance policies before you even turn on the hallway lights. Then comes the physical operational reality of keeping the building standing: utilities, maintenance, and property management. Even if tenants pay their own interior electricity, the landlord pays for exterior lighting, trash valet, water, sewer, and common area heating. That is another $4,000 a month. Next is professional property management. Offloading tenant complaints, rent collection, and lease enforcement to a third-party management firm costs 4 to 8% of gross collections, or about $3,500 a month. And look, if routine maintenance wasn't painful enough, the real estate game is constantly threatened by an invisible ticking clock known as capital expenditures, or CapEx. Unlike operational expenses like fixing a running toilet, CapEx refers to replacing major structural assets that inevitably wear out. Every roof has a 20-year lifespan, every parking lot needs repaving every 15 years, and every commercial boiler will eventually die in the dead of winter. A single roof replacement on a 40-unit complex can easily run $80,000. Smart operators set aside a dedicated CapEx reserve of $300 per unit per year, eating another $12,000 annually out of the operational pool. But here is where the money story gets really interesting. Not all real estate revenue streams are created equal, and how you optimize your asset determines whether you generate passive wealth or spiral into negative cash flow. The biggest trap that destroys first-time real estate owners is ignoring vacancy and credit loss. A spreadsheet assumes 100% of your units will be occupied 365 days a year. The real world doesn't work like that. Between tenant lease turnovers, units sitting empty while being renovated, and non-paying tenants being evicted, a realistic property operates at a 5 to 8% vacancy rate. On our 40-unit complex, an 8% vacancy rate instantly erases nearly $58,000 a year from your top line, dropping your actual collected revenue from $720,000 down to $662,000. To survive this revenue drop, veteran real estate operators do not just collect base rent. They engineer ancillary income streams that carry staggering 90% gross margins. They install community laundry facilities that generate $800 a month in pure cash flow. They charge $40 a month per unit for reserved covered parking spots, generating another $1,600 monthly out of space they already own. They implement pet rent fees, charging an extra $35 per month per pet, which adds another $1,000 in monthly revenue while covering potential carpet wear. They even bill back utilities to tenants using ratio utility billing systems, or RUBS, effectively shifting 30% of common utility costs back onto the residents. By stacking these high-margin ancillary fees, a master real estate operator can raise the effective yield of a property by 10 to 15% without ever raising the base rent past market limits. So let us run the complete brutal math on our 40-unit apartment complex, pulling in $720,000 in gross potential rent. After factoring in an 8% vacancy and credit loss, your actual collected income sits at $662,000. Adding $38,000 in ancillary income brings your total effective gross income back up to $700,000. Now, let us subtract operating expenses. $75,000 goes to property taxes, $35,000 goes to property insurance, $48,000 goes to utilities and trash removal, $35,000 goes to third-party management fees. $45,000 goes to routine repairs and turnover maintenance. $12,000 goes to CapEx reserves. $15,000 goes to legal fees, marketing, and accounting software. And $10,000 goes to payroll for a part-time on-site handyman. Your total operating expenses sit at $295,000. Subtracting that from your $700,000 in revenue leaves you with a net operating income, or NOI, of $405,000. This is the golden metric of commercial real estate. Net operating income is the absolute baseline value of the business before paying debt. But we are not done yet, because the bank still needs to get paid. On our $6 million property with a $4.5 million commercial loan at a 6% interest rate, your annual debt service, paying principal and interest, chews up roughly $324,000 every year. What is left at the bottom of the ledger? Roughly $81,000 in net pre-tax cash flow. On a property generating over $700,000 in revenue and holding $6 million in asset value, the owner walks away with $81,000 in distributable cash, a raw cash-on-cash return of around 4.5% on their initial $1.8 million capital investment. If vacancy spikes by just 6% due to a local corporate factory closing down, that entire $81,000 cash flow vanishes into thin air, leaving the owner scrambling to cover the bank payment out of their personal pocket. So why do so many people buy real estate if the immediate cash-on-cash return looks so modest? It comes down to four mathematical engines working simultaneously beneath the surface: cash flow, principal reduction, tax shelter through depreciation, and appreciation. While the cash flow might only yield 4 to 5% initially, your tenants are paying off your $4.5 million mortgage every single month. Over the first 5 years, tenant rent payments reduce your principal debt balance by over $300,000, building equity for you entirely funded by other people's money. Furthermore, the tax code treats real estate like a privileged asset class through paper losses called depreciation. The IRS allows you to pretend that the physical building structure is losing its entire value over 27.5 years. On a $6 million asset where the building structure is worth $4.8 million, you can write off roughly $174,000 in paper depreciation every single year. That means your $81,000 in actual cash flow is completely shielded from income taxes, and you can even use the leftover paper loss to offset income from other investments. So why do so many real estate operators go completely broke despite these tax shields and guaranteed demand? It comes down to three classic financial landmines that devour first-time owners. The first landmine is floating rate debt and loan maturity shock. Many real estate investors buy properties using short-term bridge loans with variable interest rates, planning to renovate the building and refinance in 3 years. If interest rates surge from 3% to 7% during those 3 years, their monthly mortgage payment instantly doubles. A property that was cash flowing perfectly fine suddenly faces a negative cash flow of $10,000 a month, forcing the owner into default and foreclosure when the loan matures and cannot be refinanced. The second landmine is bad tenant screening and eviction delays. A single bad tenant who stops paying rent and deliberately damages your property can cause financial havoc. In tenant-friendly legal jurisdictions, the legal process to evict a non-paying squatter can take anywhere from 6 months to over a year. During that entire time, you are collecting zero rent for that unit, paying thousands in attorney fees, and still forced to pay the mortgage, taxes, and utilities. If you have 3 squatted units at the same time in a 40-unit building, your cash margin is completely destroyed. The third landmine is deferred maintenance and CapEx cascades. When cash flow gets tight, novice owners make the fatal mistake of skipping routine maintenance. They postpone replacing an aging roof or ignore minor plumbing leaks. But deferred maintenance compounds exponentially. A $200 roof leak left unaddressed turns into a $20,000 toxic mold infestation that renders 4 units completely uninhabitable, destroying rent roll revenue while triggering emergency repair bills you cannot afford. So how do the top elite real estate moguls actually build multi-million-dollar empires while keeping their risks under control? They master the value-add forced appreciation strategy. Rather than buying shiny new properties at top dollar that yield low returns, they seek out mismanaged, outdated properties built in the 1980s or 1990s with rents 20% below the market average. They execute a targeted capital improvement plan, spending $10,000 per unit upgrading kitchens with quartz countertops, modern cabinetry, and stainless steel appliances. By spending $10,000 to renovate a unit, they can ethically raise the monthly rent by $200. In commercial real estate, property value is determined directly by dividing net operating income by the market capitalization rate. If you raise rents by $200 a month across 40 units, you add $96,000 in annual NOI. At a 6% cap rate, that simple rent increase instantly boosts the total market value of the property by $1.6 million. Once that value is created, the elite operator doesn't sell the building and pay capital gains taxes. Instead, they execute a cash-out refinance. They go back to the bank, get a new commercial loan based on the new, higher $7.6 million valuation, pull out $2 million in tax-free equity cash proceeds, and use that money as down payments to buy 2 more apartment complexes. At the end of the day, owning a real estate business is a masterclass in financial engineering. It is an industry where you acquire massive physical assets using borrowed money, rely on hundreds of strangers to pay off your debt, fight off constant structural decay, and navigate complex municipal regulations. The operators who win aren't just landlords who know how to fix a leaky faucet. They are disciplined balance sheet managers, tax strategists, and patient capital allocators who turn brick and mortar into a perpetual wealth-building machine.